My name is Mary Pearl Apari Adu, and I'm a course tutor for corporate financial analysis. In this session, we'll be dealing with the nature and limitations of financial statements. In completion of this session, you should be able to explain the nature of financial statements and also discuss the limitations of financial statements. So, according to the American Institute of Certified Public Accountants, financial statement mirrors a combination of recorded facts, accounting conventions, and personal judgment, which we earlier stated in our earlier session. These three key items are the basics of financial statements. Now, the judgments and conventions that are applied has material effects on the preparation of the statement of financial position, the income statement, and any other statements that are included in annual reports. By that I mean the financial statements. Hence, the nature of financial statements are discussed in the subsequent slides. So we made mention of three main items that forms the basis of financial statements, and the first one is recorded facts. Now, we made mention earlier that accounting is the means by which we communicate the financial information of the firm to interested parties, who are usually the stakeholders of the firm. Now, remember that first of all, entries are being made into the value books or the ledgers, which are prepared or from which we extract a trial balance. Now, all these items or these transactions that occur in relation to the firm are all recorded in these books of original entry or the books of prime entry, and they are known as recorded facts. Therefore, any item or any transaction that is recorded first in the book of prime entry, subsequently the ledgers, and are used to prepare trial balance from which financial statements are prepared, are all facts that are recorded, and therefore we refer to them as recorded facts and figures. Now, we made mention that the annual reports incorporates both financial and non-financial information. However, there are certain information which are very relevant to the operations of the firm. However, they are not recorded facts. Example is the efficiency of labor. Like I mentioned earlier in the first section, employees are one of the key resources a firm has. However, they are not recorded in the books of accounts because they are non-financial information. So the efficiency of labor is one of the many relevant issues pertaining to firms but are not shown in financial statements since they are not recorded. However, we are placing emphasis on the fact that it is the nature of financial statements to include recorded facts. These accounting conventions are principles that have been generally accepted by accounting bodies, and therefore they form the basis of the procedures that are followed by accountants in preparing financial statements. So, for example, there are a number of principles or conventions, and one is the principle of consistency. There's also the principle of comparability that ensures that all concerns under the same industry follow the same pattern of conventions in order for comparability purposes. So there are a number of conventions that are taken into consideration when preparing financial statements of companies. There is also the International Financial Reporting Standard, which is popularly called the IFRS. Now, these are assumptions, ideas, and accepted rules that forms the basis of accounting. They include concepts, conventions, and principles, which serve as standards for recording financial transactions. So, in as much as there are a lot of conventions, there are some that are really accepted as standards, and these influences financial statements. So, the IFRS has a number of standards. And for example, when it comes to inventory, IFRS requires that closing inventory is valued at the less of cost and net realizable value. There are other conventions that also governs how you treat certain transactions when preparing the financial statements of companies. Then the next item is personal judgment. So the use of accounting concepts and conventions is greatly affected by the personal judgment of the accountants. So in as much as there are principles that has to be followed, there are conventions and there are also rules and norms. There are sometimes alternative ways to doing things or the same thing. Therefore, the accountant is at liberty to decide which method is best suitable for him or her. So, for example, in calculating, let's say, the cost of inventory, there are a number of alternative methods that are available. There's the LIFO, there's the FIFO, there's the weighted average. Now, the accountant is at liberty to choose whether they would want to use the first in, first out method, or the last in, first out, or the weighted average method of calculating the cost of inventory. Similarly, in terms of assets, when you have to calculate for depreciation, there are a number of depreciation methods that can be used: the straight line, the reducing balance, and others. So that also depends on the accountant to decide which method of calculating depreciation he or she would like to use. And all these alternative methods for calculating either cost of inventory, depreciation, or whatever it is has implications when it comes to the financial statements. Therefore, it would be very critical to pay attention to these items in financial statements and how they affect the statement. And in other words, also influence the decisions that are being made by users who rely on them. Although the financial statement has or is made up of a combination of recorded facts, personal judgment, and accounting concepts and conventions, as well as the international standards, financial statements are prepared with the aim of presenting periodic reports on the status of the business, as well as the progress that has been made by management. We made mention earlier that one of the goals of the financial statements is to make sure management render accounts of their stewardship as to how they have been able to use the resources that has been made available to them. However, there are some impediments to the realization of the goals that the preparation of these statements seeks to achieve. In as much as there are limitations to these statements, there are remedies that are available to address these limitations, and therefore you can seek redress whenever you are confronted with any of these situations as and when you are preparing financial statements. And by the going concern, I mean the assumption that the company will continue into the foreseeable future. So you'd want to assess those expenditure or income items that belong to the long term. Those are the capital expenditures and income, and those expenditures and income that are related to the short term, which will be the revenue, expenditure, and income items. And then you identify them and you suitably match them in order to disclose the real position of the firm. The second limitation of financial statements is that it shows too many contingent assets and liabilities, and also fictitious assets which have no realizable value, and also the disclosed value on the face of the financial statement of an asset. The disclosed value of an asset, which is on the face of financial statements, is not always its realizable or replacement value. In order to solve this, you have to write off fictitious assets against retained earnings, and also you have to value contingent items from past experiences and revalue your assets and liabilities from time to time in order to disclose the true position of the firm. Also, the statement of financial position is considered a static document, implying that the real position of the business may be changing on daily basis or monthly or weekly basis. However, there may be the issue of likely window dressing since the position is not truly disclosed. So you would want to employ a competent accountant with questionable professional competence, to revalue your assets and liabilities from time to time and communicate that to users. That way, even though it's a statement of financial position, it is a reflection of the true financial position of the business. Also, financial statements may not be reliable as they are based on certain concepts and conventions which may not be all the time sound and realistic. So, in order to make sure that financial statements are prepared, are realistic and can be relied upon to make decisions, you should ensure that concepts and conventions that are contradictory are eliminated from it, and then you place emphasis to those conventions that are suitable for the company. So, for example, with the concept of valuing methods of valuing inventory. So, if you have a perishable or a company that deals in perishable goods, you'd want to consider which method you would use, either LIFO, FIFO, or weighted average. So, if you are dealing in perishable goods, so you'd want to consider not using the LIFO but rather the FIFO, so that you can sell out, or you can sell your your products that have been in stock for long, and then you can keep the fresh products. So you should make sure that you eliminate any contradictions. Although there are a number of alternative concepts and conventions that can be used, you should place emphasis to those ones that are more suitable for the company. Also, it shows that financial items that have taken place at historical cost may not always be totally helpful for future planning. We know that accounting is based on the historical cost concept, and usually we have book values. However, if you want to make forecasts due to changing economic situations, you would want to make sure that you use the inflation accounting to disclose the effect of price changes and disclose the current position. So, in cases where there's been recent hikes in interest rates and inflation rates, we want to consider all that and disclose the real position of the firm. And also, the analysis, which is based on a single year statement, will not be very useful. So, usually, when financial statements are prepared in annual reports, you realize that they are comparative. So, if the annual report is for 2016, you have the financial statement for both 2015 and 2016, that's the prior years, in order to aid comparative analysis and also trend analysis and make more meaningful analysis of the firm. Also, comparison will be difficult if different methods of accounting are followed by different firms in the same industry. So earlier on, we mentioned the principle of consistency and comparability. So you should make sure that in analyzing when analyzing financial statements of companies, you'd want to make sure that the same accounting standards are applicable for companies in the same industry in order to aid comparability and to ensure uniformity and consistency in principles. IFRS helps in solving this issue. And also, the financial statement only discloses monetary facts. So, non monetary information or facts, including quality of products, efficiency of labor, industrial relations, and all those non monetary issues are not taken into consideration. And all these factors or these items have enormous effects on the financial position of the firm, including human resources. Therefore, specifically for human resources, you can adopt the human resource accounting to show the real strength of the firm in terms of the quality and the quantity of human resources that the firm has. We will deal with human resource accounting in our latter units. Also, the financial statement is influenced by the personal judgment of the accountant, and the soundness of these judgments is dependent upon the competence of the manager or the accountant. Earlier, we made mention that the nature of financial statements is such that it includes recorded facts, accounting concepts and conventions, IFRS, and personal judgments. So therefore, in order to make sure that the accountants make sound decisions in terms of their judgment, which could be in relation to the kind of methods used for measuring inventory or for charging depreciation, either the straight line or reducing balance or whatever method. All their decisions or their judgments should be guided by accounting standards. So in this session, we explained recorded facts, accounting conventions, IFRS, and personal judgments which form the nature of financial statements. Also, we address the limitations in the financial statements and the redress to seek in the course of preparing these statements.